According to some pundits, we had a bloodbath in the information technology sector yesterday. Let's turn to FAST Garphs and find out how bad it really was, and let's find out if these stocks are now on sale after dropping some of them more than 10% yesterday. Hello everybody, this is Chuck Carnevale, co-founder of FAST Garphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. I got an interesting comment on my last video based on what happened yesterday in the semiconductor industry. It was from, I want to give a shout out to Michael Barger, 800, who said, "Great video, Chuck. What are your thoughts on AVGO or Broadcom? It's on pace today for the largest percentage decrease since March 18th, 2020. Think it's time to take profit or sell it? Perhaps a video on it." Well, it's an interesting question because what I really liked about the question was it wasn't the typical question you get when a stock drops like that. It wasn't, should I buy it now? It was, should I sell it now? Michael obviously recognized that the stock is still highly valued. So with all of the bloodbath, quote unquote, that we had yesterday in information technology, let's put it into perspective by using the FAST Garphs Fundamentals Analyzer software tool and see what really it's all about. And I'm going to let you decide whether or not you think these stocks are buyable now after dropping some of them more than 10% yesterday, some of them around 8% yesterday. So let's go ahead and take a look at them. And I've created a portfolio, and let's go ahead and look at that portfolio via FAST Garphs. I called this portfolio actually hammered. I had a typo here with an N, but I want you to only look at the information technology sector. I've got 15 stocks that I basically took from Yahoo Finance, and these were yesterday's biggest losers. Okay, and as you can see, I did include a consumer discretionary stock because I want to use it to illustrate a lesson on valuation later, but my main focus is on these information technology stocks. As you can see, most of them, they're all semiconductors. Some are semiconductor materials and equipment, and others are just pure semiconductor companies. And a lot of them you'll recognize by name. Now, yesterday's price return, the biggest loser was Nova Limited, symbol NVMI, and it dropped over 13% yesterday. The next one was Onto Innovation. It dropped around 13%, and then Camtek Ltd. But those are not really well-known stocks. Now you get into ASML. ASML dropped almost 11%. Applied Materials dropped over 10.5%. Advanced Micro Devices dropped by 10%. Marvell Technologies dropped over 10%. Lam Research dropped over 10%. Credo Technology Group we'll call it 10% for round numbers. And same with KLA Corp, it dropped about 9.85%. Now, when you look at names like Semtech, it dropped 9%. And then Qualcomm, an A-rated, one of the more popular semiconductor stocks, dropped over 8.5%. Broadcom, which Michael Barger talked about, dropped just under 8%. Taiwan Semiconductor dropped over 7%. And then the king of all the AI stocks, semiconductors, Nvidia, dropped 6.6%. But what we're going to do is we're going to put this into perspective and look at each of these companies from a standpoint of, did the adjustment in prices yesterday make a difference as far as whether they're buyable or are they still sellable? And we're going to talk about valuation and how it applies. So let's start with Applied Materials here. I'm going to do these in alphabetical order because it's easiest to do. Now, the long-term look at Applied Materials, if we look at the company from a standpoint of operating earnings, that's the orange line on the graph. I'm going to take the blue line off for a moment. I'm going to take the price line off. You can see that it's been a good earner. It's grown over 21%. I'm going to shorten the time frame to about 14 years here and get rid of the Great Recession. So since 2013, it's grown over 20% a year. If I put weekly closing stock prices on the graph, you can see that there was a time when the stock tracked at around 20 times earnings. And if I put the normal PE on the graph, you can also see that there were several times where the stock traded at 16 times earnings or less. Okay, that's been normal for the stock. Today, we have the stock trading at a blended PE ratio of 26.58. And as you can see, we did have a precipitous drop yesterday. It fell by 10.48%, as I said earlier. But I do want to point out that the stock is still trading at a very high valuation. Even though the headlines would say it dropped over 10%, when you look at it from this longer term perspective with FAST Garphs, it really is obviously a better buy today than it was yesterday, at the beginning of the day at least. And if you look at forecasting real quick, clearly the stock is expected to grow at 13%. Clearly it's overvalued, and it remains overvalued. And that correction, although it was 10%, doesn't really change the relative risk of investing in a stock like Applied Materials. So let's go on. Let's look at Advanced Micro Devices next, which is another very popular tech stock. And I'm going to keep it at the 14. Now, it had 31% growth, but I do want you to notice there were some periods in this time frame where it actually lost money. But looking from 2017 on, we had some really strong growth, sometimes very fast at over 170%, and then followed by 39%, followed by another 100%, and another 100%, then only 25%, and then we had a down year. But regardless, the stock is traded at around a 53 multiple during this time frame. That's the blue line on the graph. And it's currently trading close to that right now with a blended PE of 51. Now, it dropped 10.2% yesterday, but when you look at it from this long-term perspective, it just hardly looks like a blip. It hardly looks like it really changed very much at all. And in fact, it hasn't. Now, the thing about a stock like this, and I've talked about this many times in the past, if you have a very powerful growth situation in a stock, and Advanced Micro Devices is expected to grow, and it's very widely followed by over 40 analysts expected to grow on an average of almost 42% for the next 2.5 years or so. 31% this year, followed by 55% next year, and followed by 35% the year after. And I do want you to notice that estimates for 2024 have actually come down, but estimates for 2025 and beyond are actually increasing a little bit. So, well, actually 2025 isn't really increasing that much. Now, if I look at the stock 6 months ago, you can do that with the FAST Graph tool by clicking on these here, and it gives you the growth rates based on the estimates from 6 months ago, 3 months ago, et cetera. But the point is, if the stock does grow at this rate, and even if you pay today's high valuation of over 50 times earnings, and it traded at a more reasonable 30 PE, this is just a what-if scenario, you would still be making over 14% a year. Now, the point is, when you're looking at high valuations like this on very powerful growth stocks, I want to make the point, you could end up seeing a drop in price to where the stock could fall down into $100 a share, which would be 35, 40% even by the end of the year. And that's trading at a 30 multiple, okay, which is lower than the growth rate. If it traded at a 42 multiple, okay, which would be the second blue line here, it would only drop about 8%. But my point is, if you held this long enough, the odds are you'd probably do pretty well. You can't really overpay for growth stocks, but you can certainly make more prudent purchases. It obviously would have been a lot better to buy Advanced Micro Devices when the company was trading down here at about a 17 multiple in October of 2022. That's really the key point that I want to make with this look at these tech stocks. And as you can see, looking at ASML Holdings, a major semiconductor out of the Netherlands, over a $373 billion market cap, I want you to note that it traded consistently between, in this case, 18.4 and 33 times earnings, historically most of the time. And then we hit COVID, it had a little drop, but then it started getting these real high valuations post-COVID. And when the stock got up into a high valuation in September of 2021, where the PE got to 58, we can see that there was an immediate drawdown here for over the next year or so, and I won't hit it perfectly, but it fell by over 55%. But yet, once again, when you got really strong growth, if you would have held during this period of time, and FAST Graphs lets you figure this, even after yesterday's close, you'd have still had a positive rate of return, although only 4%. Now, in contrast, if you'd have bought it after it fell so precipitously in 2022 and held it even after yesterday's almost 11% drop, you'd have made 67% annualized. Your stock would have increased from a price of $386 to the current price of $948. So these stocks can be very, very powerful, but a 10% correction didn't really change very much. Now, Michael Barber asked about AVGO. I'm going to shorten the time frame on AVGO even more because I want you to note that a 15 multiple is where this stock has traditionally traded at. I call this a blue line stock, meaning that the market has typically given it a discount to its growth. It's averaged almost 20% growth since the beginning of 2017, okay? But the stock traded low. And then once the AI craze kind of came, we saw the stock increase dramatically. Now, this is one of the largest holdings in the portfolio that I manage for my money management firm. And it's one of the largest holdings we have because I bought it years ago at a much more reasonable price. What I recently did about 2 weeks ago is I sold half of the position, and it's still one of the larger positions in our portfolios. Now, the idea was the stock has momentum, and it's obviously trading at a very high valuation. The name of my money management firm is EDMP, which is an acronym for Earnings Determined Market Price, and then in parentheses, in the long run. But as I've said in other times, there's an evil twin sister, EDMP, that states emotions determine market price in the short run. So we made a lot of money in this stock. We sold half of it, and we booked multiples of what we originally invested, and yet we still have a very large holding in the position. It's still actually almost overweight in most of the portfolios I manage, but I'm going to continue to play it for the momentum, but I'm doing it, in my mind, risk-free from this point. We're now gambling house money because we have made more than we would have expected to make by now by taking half of it out and holding it. So I do think it is a short-term sell. But once again, this is one of these other stocks, these semiconductors, expected to grow at 20% a year. And even at a 19 PE, it wouldn't really lose you a lot of money, but it would be down some. But if it traded at its normal multiple of, say, closer to 15, then the stock could lose 35 or 40% of the money before it started growing again. Now, if it maintained a high multiple like this, you would earn about the 20% that the company would get in growing, but that would be a big risk. In other words, this is all about risk. When you're looking at high valuations like this, common sense and your powers of observation ought to tell you that the stock is still trading at a valuation that is not supported by its fundamentals. And that's the key thing. But yet, yesterday's price, even as severe as it was, almost 8% drop, didn't really change the picture very much. Obviously, it changed it by 8%, but it didn't change it by very much. And going on, Camtek is another one. You can see this is a stock that typically traded somewhere between 20 and 30 times earnings, usually lower than 20 times earnings, by the way, most of the time. Got caught up in the AI craze. It's an Israeli-based company. We see this huge parabolic advance. Now, it fell almost 11.5% yesterday, and that is a precipitous drop. You can see it when you're looking at the price line there, but it really hasn't changed the posture of saying if you owned the stock and you bought it when it was more reasonably priced, this would probably be a prudent decision to go ahead and take either some of the money off the table, if not all of it, with all these tech stocks. Now, Credo Technologies is a smaller cap stock in the Cayman Islands. It dropped almost 10%, but it's almost hardly noticeable looking at this graph. And I don't know very much about this company other than I still consider it extremely overvalued. I'm going to save that one I just kind of blew by there because that's the retail stock. I want to talk about that at the end of this video from a valuation perspective. KLA Corporation, another semiconductor A-rated company. You can see the normal valuation of the stock have been around 15 to maybe 20 times earnings. And when it gets above even the 20 times earnings line, which in this case is the orange line, those were times that usually led to a drop in the stock price. The stock price fell almost 10% yesterday. You can see that right here after running up very strongly for most of the year here. I still consider it overvalued, but here's another example of if you're looking at the forecast, it's expected to grow at about 18% a year. If it traded at a normal 18 multiple, you could lose a little bit of money by investing in the stock today. But on the other hand, if you owned this stock for the long run and held it even through its normal multiple, would still indicate a loss. My point is valuation matters, and it matters a lot. And even though these are great companies and they've had great performance, no one's denying the great performance they've had, these stocks are clearly overvalued today. And they've become overvalued for most of the year. And this happens. but that's the EDMP evil twin sister, where emotions are driving market price. Fundamentals are not supporting the market prices of these stocks. That's the message I want to get across. We see the same thing with Lam Research. Once again, a market normally priced it at a pretty reasonable levels. And of course, because of the volatility of stock prices, there were times when it really priced it at high multiples and times when it priced it at real low multiples. And saying that always reminds me of one of the quips that Warren Buffett made when he talked about buying, I think it was the Washington Post or one of his public companies, versus buying a farm up in upstate New York. The one thing he said difference in the investments were nobody came to his farm and put their heads over his fence and were yelling quotes that they wanted to pay for or buy his farm from him. Where if you get the publicly traded company and it's so liquid, people were literally giving you bids and ask prices of every moment of every market day that the market's open. And my point is liquidity. The good news about owning stocks is the liquidity. The bad news is that they're liquid. So my point is that liquidity comes with its baggage as well as with its opportunity, where it's one of the reasons why people who invest in real estate and who love real estate investing, I think, are right, because the difference between investing in real estate and liquid stocks is that people tend to own real estate for long periods of time. And buy and hold, in my view, the best secret to success. But again, Lam fell by 10% yesterday, and yet it's still significantly overvalued. It really hasn't changed the picture. And from a value investor's point of view, love the company, do not like the current valuation, although it is expected to be a good, strong growth stock. Marvell Technologies dropped by over 10%, but it's been flatlining all year. And notice again, when it got really overvalued back in 2021, you had this very large drawdown. And my point is, if you're patient with these stocks that are expected to grow, I do believe you'll get opportunities to buy them at reasonable valuations. Yesterday may just be the beginning of that. We'll have to see how it unfolds over the next couple of weeks. But again, a 10% drop, it didn't really change anything very much as far as whether the stock is fairly valued, overvalued, or undervalued. Now, Nvidia, the king, fell by 6.6%. Maybe one of the highest quality, AA rated, less than 16% debt. Very powerful growth. And when I look at this on a forecasting basis, expected to grow at 35% a year, at a 35 multiple, it generated less than a 2% annualized rate of return. That's if it earned what the analysts say it's going to earn, and it traded at a 30 multiple. For it to continue to be a good investment, it would have to trade at a 60 multiple. And again, when you look at the historical levels of Nvidia, it did have times where it traded at 30 multiple, also had times where it traded at 48. But even when it got up to like a 75 multiple, and today it's at a 60 multiple, and that turned out to be for at least a couple of years. Sometimes it pays to have patience when you're investing in especially these high growth stocks. Nova Limited, I talked about, it dropped by over 13% yesterday. That was rather substantial, but still it's a long way from the company coming down to its fair valuation. And that's what we're really seeing with FAST Garphs. You get that perspective where instead of looking at a headline saying Nova was down 13%, does that make it a buy? Well, we don't know that until we measure the fundamental value of the company versus where the current stock price sits. And again, all these stocks are expected to continue growing, but if you have patience, you'll be able to buy them, in my opinion, at a much more attractive level. Onto Innovation is another case where even though we had a 13% correction yesterday, it really didn't change the profile for the valuation profile very much at all. The stock is still massively overvalued. Qualcomm is one that's a little different than some of the others. If we look at it, if I open this up and get a broader term perspective, you can see that Qualcomm is a relatively cyclical stock. You can see when valuations were high, like here at 40 times earnings, you can see that there would have been a period of time where you made no money owning this stock for several years, even though the company didn't do all that badly. So valuation matters, and it matters a lot. We had this huge surge in earnings in fiscal 2022, which ends in September, and we see the stock price really rallied. And then now with the down earnings in fiscal year 2023, we saw a big correction, but now that earnings are expected to begin growing again, and again, the AI hype ran the stock up to a very high level, but it did correct over 8.6% yesterday. But again, if I'm looking at forecasting on the stock, It's expected to grow at 12% going forward. Again, we've got a pretty credible amount of analysts, 34 for the next year or two, dropping down to 15. The stock wouldn't make you much money if it traded at a 15 multiple. But if you look at the normal multiple of this stock, which has been closer to 17, even if you bought it today, you wouldn't make the money you deserve to make, in my opinion, but you could still end up making 7 or 8%. So Qualcomm is different than a lot of them. It might be getting close to being a good buy. And then, of course, we can go in and really check the market value today and see, is the market rallying a little bit? No, it's down another 1.6% today, so it's getting even closer. This might be one you want to keep your eye on because it may be coming into fair value very shortly here. The next stock I want to look at would be Semtech. I like this one because it dropped 9% yesterday, but you can almost barely see that on the graph. But what's interesting is you can see the valuation levels here. You can see the cyclicality of earnings. If I scroll back here, before the earnings fell, the company was a double-digit grower and the stock price tracked that. But you can see when it gets overvalued how the correction occurs. Bring it back up, we saw the correction in price because we saw a correction in earnings. Earnings fell from 282 to 14 cents, but then the stock is beginning to rally with over a 300% growth rate. And then, of course, we got this high valuation. Looking at forecasting, the stock is expected to grow at a very high rate, but it's obviously got a lot of risk buying it today, but less risk today than we had, let's say, over the last 4 or 5 years. That's where valuation really makes a difference. Now, I want to end this by, I want to go ahead and look at FIVE, the symbol FIVE, which is the retailer Five Below. And by the way, if you don't know these stocks, if you're a FAST Garphs subscriber, you can go into the company's corporate website and learn about the company if you want. But what I wanted you to see here was the danger of valuation, of high valuation. This stock was very, very popular from a standpoint of price performance. The market has put an average PE of 42 on the stock. That's the blue line on the graph. And there are many times where it traded at higher multiples than that. And it rarely ever got down to even a 20 multiple, which would be P equals growth rate, the Peter Lynch multiple, if you will, which would be a fair value multiple. Although it does trade at below, it trades at almost 14 times earnings now. Now, it dropped 25%. Ironically, even though the semiconductors were falling yesterday, it fell the most yesterday. And it's got a flat earnings profile. But I want you to notice this, and this is the point I want to make. I would think that it could be years and years before this stock could ever get back to a 30 or 40 multiple. If you look at forecasting on the stock, it is expected to grow at about 10% a year, but that growth rate does not suggest a 40 multiple. I could see it trading at a 15 or 20 multiple, but it does not suggest a 40 multiple like the normal multiple has been. It would have to do that for you to make any money. Now, the question is, you're taking a lot less risk investing in Five Below today than you would have been any other time almost on this graph and even over the last 7 or 8 years. But now, is it a risk worth taking today? Again, I'm going to let you be the judge of that. Anyway, this has been Chuck Carnevale, co-founder of FAST Garphs, the Fundamentals Analyzer software tool. Kind of going through the bloodbath, as many people were calling it. I got a lot of calls on that yesterday saying tech's in a bloodbath. Should we be buying? What should we be doing? I liked Michael Barger's approach. He said, hey, AVGO's beginning to show some weakness. Should we be selling it or taking some of the money off the table? That would be the prudent thing to do with these tech stocks. In the long run, I think if you could buy these stocks at attractive valuations, you could end up doing very, very well if you're a growth stock investor and if you have the stomach for the volatility that I showed throughout this video. But anyway, I just wanted to put yesterday's quote-unquote information technology or semiconductor drop in stock prices in perspective for you. And that's the real beauty of FAST Garphs. It gives you the perspective of the business value versus the stock value. And I hope you all were able to recognize that throughout this video. Thanks for watching. If you haven't subscribed to the channel, please do. Give me a like, ring the bell, and take a look at subscribing in FAST Garphs. It's a great tool to help you make smarter long-term investment decisions. Remember, emotions determine market price in the short run, but earnings determine market price in the long run. Thanks for watching.